Imagine two people, same age, same salary, same amount of money to invest. One of them, 10 years later, has quietly built a portfolio worth hundreds of thousands of dollars. The other one, he's lost money. Not a little money, a lot of it. And here's the strangest part. He was actually more interested in the stock market than the first guy. He checked his portfolio every single day. He read articles, watched videos, followed financial news obsessively. So how did the person who paid less attention end up with more money? That question is what this entire video is about, because the answer reveals something uncomfortable, something that most financial channels won't tell you. The stock market doesn't punish ignorance as much as it punishes behavior, and almost nobody talks about that. Here's what most people believe about the stock market. They believe it's like a test. Study hard enough, learn the right strategies, pick the right stocks, and you'll win. Fail to study, and you'll lose. So they approach investing like it's a puzzle to be solved, a game of information. The person with the best data wins. And that belief sounds completely reasonable. It's the same logic that works everywhere else in life. Work harder at your job, get a better outcome. Study more for the exam, get a better grade. Practice more, improve more. But the stock market doesn't follow that logic. In fact, sometimes it reverses it. Let me show you what actually happens to most people when they first start investing. They open a brokerage account, they deposit some money, and then, because they're responsible, curious adults, they start paying attention. They check the market, they read the news, and at some point, they see something scary. Maybe the market drops 2% in a day. Maybe there's a headline about a recession. Maybe their portfolio goes from green to red. And something happens inside their brain, something they didn't expect. They feel panic. Not mild discomfort, actual panic. The same kind of feeling you get when you think you've lost your wallet or when your car makes a strange noise on the highway. That tight, urgent, do something right now feeling. And so they do something. They sell. And that's where the story usually ends badly. Let me introduce you to two mental forces that are quietly destroying most investors' returns. The first one is called loss aversion, and it was discovered by two psychologists, Daniel Kahneman and Amos Tversky, who spent years studying how humans actually make decisions. What they found was fascinating and a little disturbing. Losing money feels about twice as painful as gaining the same amount feels good. Think about that for a second. If you made $500 today, you'd feel pretty happy. But if you lost $500 today, you'd feel devastated, upset, like something had been stolen from you. Even though it's the exact same amount of money, just in different directions, your brain treats them completely differently. This is why people sell during market crashes. Not because selling is the smart thing to do, but because the pain of watching their portfolio go down feels so unbearable that their brain demands they make it stop. Selling feels like relief, like escaping. But here's what's actually happening when they sell. They're locking in a loss and sitting on the sidelines, usually right before the market recovers. This is one of the cruelest patterns in investing. Markets go down, people panic and sell. Markets recover, people who sold miss the recovery, and then those same people often buy back in right when prices are high again, because now everything looks safe and exciting again. They buy high, sell low, repeat. It sounds insane, but millions of people do this every single year, over and over again, because they're not fighting the market, they're fighting their own brain, and most of the time, the brain wins. The second mental force is called recency bias, and this one is just as dangerous. Recency bias means your brain gives way too much importance to whatever just happened recently. If the market went up for the last 6 months, your brain says, this is the new normal, this will keep going, buy more. If the market crashed last week, your brain says, this is a disaster, this is the new reality, sell everything. Your brain is basically a pattern recognition machine that's terrible at thinking long term. It evolved to help you survive in a world where the most recent information was the most important information.
If a tiger attacked someone in your village yesterday, assume there are more tigers today. That logic kept humans alive for thousands of years, but it is absolutely terrible for investing. Because in investing, the most recent event is often the least useful information for predicting what comes next. Now, let's go back to our two investors from the beginning. The first investor, the one who lost money despite trying hard, was doing everything his emotions told him to do. When the market dropped, he felt the pain and sold. When it recovered and started rising, he felt the excitement and bought back in. He was responsive, reactive, emotionally engaged. The second investor, the one who quietly built wealth, wasn't smarter, wasn't luckier, wasn't better at picking stocks. He just did something that sounds almost embarrassingly simple. He bought a low-cost index fund, something that tracks the overall stock market, and he basically ignored it. He set up automatic monthly contributions. He didn't check it every day. He didn't react to headlines. He didn't sell when things got scary. He just let time do the work. And time, it turns out, is the most underrated force in investing. Here's a number that almost nobody talks about enough. Between 1928 and today, the U.S. stock market has averaged a return of roughly 9 to 10% per year. Through world wars, through the Great Depression, through financial crises, through pandemics, the overall trend has always been upward, even though individual years can look absolutely terrifying. But here's the catch. That 9 to 10% average, most individual investors never actually capture it. A famous study by a firm called Dalbar tracked investor returns for decades, and they found something shocking. While the market returned around 10% per year, the average investor only captured about 3 to 4%, sometimes less. The difference wasn't bad stock picks, it was behavior. It was panic selling. It was chasing trends. It was buying high and selling low over and over again because emotions were running the decision-making instead of logic. The market offered 10%. Human behavior cut it in half or worse. There's a name for this gap. It's called the behavior gap, and it's the single most expensive financial mistake that almost nobody is talking about. Here's a metaphor that might help make this click. Imagine you plant a mango tree. In the first few years, it grows slowly. Some years, it barely grows at all. Some years, a storm comes and breaks a branch. And every time something goes wrong, there's a voice in your head saying, maybe I should dig it up and try again somewhere else. But the people who actually get mangoes are the ones who leave the tree alone. They water it. They're patient. And after enough time passes, they have a tree producing more fruit than they can eat. The people who kept digging up their tree and replanting it somewhere else, they never got fruit. They were always starting over, always reacting, always chasing better conditions that never quite arrived. The stock market is that tree, and most people never stop digging. So what do you actually do with this? First, understand that your emotions are not your ally in investing. They're a survival mechanism built for a completely different world. When the market drops and your stomach drops with it, that feeling is real, but acting on it is almost always a mistake. The single most valuable skill in investing is not stock analysis. It's learning to sit still when every instinct tells you to run. Second, simplify. You do not need to pick individual stocks. You do not need to find the next big thing. History has shown repeatedly that most professional fund managers, people who do this full-time with teams of analysts and billions of dollars in resources, cannot consistently beat a simple index fund over the long term. If they can't do it, what makes any of us think we can do it part-time while also holding down a regular job and raising a family? Buy the market. Keep costs low. Invest consistently, whether the market is up, down, or sideways. Third, change your relationship with market drops. A falling market is not a disaster if you're a long-term investor. It's actually a sale. The same shares you were buying at full price last month are now cheaper. That is mathematically a good thing for anyone still in the accumulation phase. The only people for whom a market drop is truly bad are people who need to sell right now. If you have time, and most people under 50 do, a crash is an opportunity in disguise. Fourth, stop watching. Seriously, checking your portfolio every day does not grow your wealth. It just gives your emotions more chances to make bad decisions. The investor who checks once a year almost always outperforms the investor who checks every morning, because the investor who checks every morning keeps doing things. And in investing, doing less is often worth more. There's a quiet irony buried in all of this. We live in the most information-rich era in human history. You can pull up a stock price in 2 seconds. You can read analysis from 1,000 different experts. You can watch financial news 24 hours a day. And all of that access, all of that information has made the average investor worse, not better, because more information means more noise. More noise means more emotional reactions. More emotional reactions mean more mistakes. The investors who win in the long run are not the ones who knew the most. They're the ones who stayed calm the longest. They're the ones who understood that wealth isn't built in the exciting moments, the hot tips, the market surges, the dramatic recoveries. It's built in the boring, quiet, disciplined middle, in the months where nothing interesting happens and you just keep adding to your investments anyway. The market is not the enemy, your behavior is. And once you understand that, really understand it, you've already gained an edge that most people will never have. Not because you know something they don't, but because you know something about yourself that they haven't figured out yet. If this gave you a different way of thinking about investing, share it with someone who needs to hear it. And if you want to go deeper into the psychology of money and how to actually build wealth without losing your mind, stick around.